expectation was that with the onset of a new government, which is supposed to be more business oriented,
Right.
with a stronger mandate, there will be better outlook with respect to India's growth, private capex,
Yeah.
and more constructive policy framework would imply better capital flows as well, both
Yes.
with respect to FDI and FPI. The reality, however, is that 15 onwards, the flow of FPI has been fairly modest.
Hello and welcome to Macro Decode. 2013, Morgan Stanley included India in the list of fragile 5 countries due to its high dependence on foreign funds for growth. It advocated a strong government as a prerequisite for inflow of foreign money and arresting depreciation of rupee. More than a decade later, in FY25, net foreign direct investment was down to its lowest level in 25 years. FY25 also saw one of the largest net foreign institutional investment outflows in recent history. As far as Rupee is concerned, we know where it stands compared to 2030. Let's talk to Dhananjay Sinha, CEO and Co-Head, Institutional Equities Systematix Group, to understand how valid was the findings of Morgan Stanley and where do we stand as a destination for foreign funds. Welcome to the show. So since 2014 has had strong governments as prescribed by Morgan Stanley.
Right.
As per this, we should have seen foreign capital flows growing year after year. How has been the inflow of FIS and FPIs in these years? How valid was the findings of Morgan Stanley?
So back in 2013-14 was labeled as a fragile 5 country, which was basically implying that amongst the various countries across the world, India was one of the most vulnerable country. You had high inflation. There were issues relating to fiscal deficit and current account deficit. There was considerable worry with respect to the growth. And we also had this whole concern about policy paralysis in the previous regime.
Exactly.
And based on that, people were quite concerned about the way market was correcting. The rupee was depreciating. So there were worries about foreign flows, capital flows into India. However, what we find is that during that time, while the foreign portfolio flows are actually slowing, over the previous 3 years, it still averaged on the positive side, roughly in the region of 50 to 60,000 crores. And the expectation was that with the onset of a new government, which is supposed to be more business oriented, with a stronger mandate, etc., there will be better outlook with respect to India's growth, with capex, and a more constructive policy framework would imply better capital flows as well, both with respect to FDI and FPI. The reality, however, is that if you look at the initial year, which is FY 14-15, there was positive flow in that anticipation. But if you look at FY15 onwards, the flow of FPI into India has been fairly modest. I would say in the 11 years ending FY20, the positive flows have been only for 2 years, and one was post-COVID, and later also when the Ukraine war ended, there was some rebound after a retrenchment. So I would say over the 11 years till FY26, most of the time it was actually outflow or very modest flow. I would say that the expectation that a stronger government, a stronger, with expected growth, etc., did not really translate into sustained, optimism as far as the FPI flows are concerned. Broadly, I would say the expectations that some of these foreign broking companies had with respect to FPI flows and foreign direct investments as well has not really translated to the kind of expectation that people had. It has not been as sanguine as they thought.
So recently, Morgan Stanley also has said that lack of direct exposure to AI, along with higher valuation of Indian stocks, is limiting FII flows into India. What do you have to say about this?
So I would say that AI has been a more recent phenomenon. US companies actually innovated a lot on the AI side. With respect to the US markets, we have seen that the contribution of the technology sector has been very strong. For instance, technology and telecom together now contributes about 45% of the total earnings for the US stock market. And the remaining part is roughly about 55%. So 45% is growing roughly at about 35%. And whereas the remaining is growing very modestly at 1.5 to 2%. If you look at India, it may not be the case. PI flows has not been robust since 515. So it's been 11 long years when FPI hasn't been contributing to the Indian markets. In fact, the contribution of FPI into Indian market has come down to an all-time low at something like 15 to 16%. And there has been a considerable outflow in the recent years. It will be actually very simplistic and naive to attribute this to lack of AI, because there are a lot of other countries around India which have actually done well. FPI participation in other countries have been relatively better than India. It will be fairly simplistic to assume that it's the lack of AI that has been contributing to the lack of FPI.
Right. Now let's look at FDI flows. So how has India's net FDI to GDP ratio evolved over these past 15 years? Has it shown any structural improvement?
I think the gross FDI has remained somewhat resilient. It has moved a little bit higher, roughly about 85 billion dollars a year. What we find here is that over time, the repatriation of or retrenchment of FDI has been fairly strong. Roughly about 15% of the FDI that came in were repatriated as retrenchment. Today, it is as high as 65%. The overall net FDI has actually been dwindling quite sharply. There has been a uptrend as far as Indian companies investing abroad. If you consider that overall FDI on a net basis is less than $1 billion. If you look at the current run rate. So if you look at the average as percentage of GDP, the peak that we saw was in 2008, which was at 3.5%. Today it is close to 0%. I would say it is in decimals. This has actually been the case, especially after 2014. So I think what we see as a trend in the FPI also reflects or resonates with the FDI trend as well. The repatriation of profit by MNC companies has also been fairly high. So let's assume that the FDI flow on gross basis is about 85 billion. The $60 billion will be repatriation. If you add up the repatriation of capital and repatriation of profit, that will be in the region of $105 billion, much larger than the gross FDI flows. That's a very important thing to really look at in terms of how much the FDI is actually contributing to the overall investment cycle. The private capex has also been fairly lackluster since 2013-14. Recently, the chief economic advisor Anant Nageshwaran also cited the concern that despite the fact that Indian companies actually seen robust growth in profits till last year, there has been a lack of private capex in the way it was expected. So I think there is commonality between FPI flows, FDI flows, and the private capex that is happening.
Yeah, I even during the COVID times, we have seen this, the profits going up and they are not investing in the capex. Right. Morgan Stanley, when said we were among the fragile five, they said that it was a problem of India where we are not able to actually attract foreign money. But then what we say is foreign flows into India are increasingly driven by global liquidity rather than domestic fundamentals. Like when a quantitative easing was happening, we have seen that the changes in the foreign flows. Is this a problem with India or is it a problem with liquidity being available in the markets?
Liquidity does matter. So if you look at quantitative easing post GFC, so you had quantitative easing 1, 2, and 3. And a taper tantrum happened in 2013. So the quantitative easing continued even after 2013. So it was hardly a tightening scenario as far as global liquidity is concerned. So the FPI flows and FDI flows has actually been moderating, long before the tapering of the liquidity happened. So I would say there is a significant domestic variable that is determining flows, and that is to do with depth of growth countries such as India has been able to demonstrate. I would say that what we also find is that 2012 onwards, the rupee has actually depreciated quite sharply, notwithstanding the fact that global liquidity was more or less accommodative, at least till 2019. If you look at 2019 onwards till now, I would say the rupee has depreciated by almost like 100%, and this is significantly higher than I would say developing emerging markets currency index, which is at half the rate compared to INR USD. As a result, whatever returns that foreign investors rated from India was actually normalized also because of the rupee depreciation. So the dollar returns have actually been fairly modest. So if you look at the other countries, earnings growth were much more stronger, valuations were lesser. So if you look at the valuation adjusted for earnings growth, Indian benchmarks are at a much higher level. First, these are the dynamics that are very relevant for FPI flows. And this is quite contrary to the fact that your GDP growth is shown to be one of the highest in the world at 8%, 6. So clearly, if you look at it, growth adjusted valuation basis, we are on the higher side. Also, if you look at the market cap to GDP ratio, we have actually gone up to almost like 135%. Remember, our GDP has been scaled down by roughly about 3-4% in nominal terms. That also sort of moves up the valuation. So
Right. So, what do you think, what is jacking up the valuations right now? Because we are not seeing inflows coming from the foreign funds,
yes,
but still valuations are much higher.
yes.
And the stock market's performance also has not been that great.
Why the underperformance has been there is largely because of the FPI participation has been coming down successively over the last 10 odd years, and more recently it has been fairly intensive in the last 3 years. What is holding up the market even at a steady level that we are seeing is the fact that the domestic flows have been fairly robust. The mutual fund flows, especially on the equity for equity schemes, has been hovering about something like 25,000 per month to 40,000 per month. It's been fairly volatile. Some of the family offices are holding up the market well. So you have valuations significantly higher than what would be attributable to the low earnings growth that has been delivered till now over the last, let's say, 12 to 18 months time.
So, as you rightly said, SIP flows and retail participation in the markets had increased in the recent years. But can domestic institutional investors fully offset large-scale FII exits?
FPIs are selling and domestic investors are buying, right? So, in a way, the domestic investors are providing exit route to the FPI. We also need to understand that there has also been a lot of primary issuances by domestic companies. So essentially, the domestic investors are also providing opportunities for companies to raise money in the market. Domestic companies have not been utilizing that for real investment purposes in machinery, plant and machinery, etc., which is also corroborated by the chief economic advisor. It has been a consistent worry for the government over the last 7-8 years. So, notwithstanding the fact that post-pandemic boundaries for companies have been fairly good till FY25, with profit rising by 20-25% on a CAGR basis. Also, the market has been supportive of absorbing primary issuances by companies. Retail investors are actually providing that demand both for the exit for FPIs and also the supply that is coming from the corporate.
Right. As the stock markets have not been performing, as was expected, do you think the retail investors would probably feel a little disinterested with the stock markets going ahead?
So yeah, absolutely right. So if you look at the number of SIPs that are there, there is a sort of stagnancy and a little bit of decline that has happened. If you have underperformance of the market, and let's say over the last 1.5 years, market has not really given any positive return for investors. And if you look at the broader level, I would say the erosion in net worth has been fairly large. Multiple small cap, mid cap company stocks have actually eroded by roughly about 40, 50. The SIP numbers have actually started to come off, but I would say that there's good amount of money that is there with high net worth individual or affluent investors, or also family offices. They are sitting on certain amount of cash that is getting deployed in the market. So that's kind of supportive. But we need to really fundamentally understand what kind of earnings growth can we expect over the next 3 years. Current expectation, as far as consensus forecast is concerned, is somewhere around 13 to 15% growth. One need to also consider the fact that you have the crude oil price hovering around 100. The cost of manufacturing might start to rise. You might actually see margins contraction happening. So I would say that expectation of 15%, 13% growth is something we are skeptical about. And as a result of that, it will be important to really put into context the participation of FPI flows and also domestic participation when earnings are not really supportive.
With global capital becoming more selective, where does India stand among the emerging markets in attractive debt?
Well, I would say that, as I said, we need to have a coherent growth narrative. So if you do not have AI, as I said, that's not a very important variable. When the technology boom was happening, especially after the dot-com bust, you had a significant contribution of technology companies into India's growth and overall profit. 2007 or 2006, earnings growth of technology firms were in the region of 25 to 30% for a sustained period of time. So I would say that what really attracted FPI flows after that is the fact that you had a very robust domestic economy in terms of private capex across multiple sectors, not just technologies. Post, I would say, given the context of global protectionism, we have not really seen that kind of robustness as far as the overall growth is concerned. Keeping aside the GDP number, I would say earnings growth from FY14 to FY19 for Nifty companies has been roughly about 3.5%, much lower than the real GDP growth or the nominal GDP growth. And I would say in the recent times, again, we are actually trending towards that. So we need to create a cogent growth strategy which can stimulate the private capex in India. If there is a broad-based growth with respect to domestic consumption, investments, and the banking sector at large, there can be it can stimulate foreign capital, both FPI and FDI. So I think the government is now getting aware of this dichotomy between the underlying growth and the headline growth that is reflected in the GDP. And that is why we saw last year RBI providing liquidity and also rate cuts. And then you had the GST reduction and income tax relaxation. But those are counter-cyclical measures. These are not really structural measures. What we need is a structural measure that is more rooted to policy levels at state levels and government level that can stimulate manufacturing, it can stimulate employment. We need to have more employment intensive manufacturing sector happening that can resurrect overall household income in real terms and also generate domestic demand. I think that's where the key solution lies.
Right. So that was Mr. Dhananjay Sinha. He was telling that the government has to work on policy. Policy is what matters and not the strength of the government. Right policies for manufacturing, you will definitely attract foreign funds. Thank you for joining me on the show.
Thank you.